Hello, everyone. My name is Victor Lai with BCM, and welcome to part 5 of Learn About Stocks. This is the last video in this series. In this video, we're going to walk through a real-world example of fundamental analysis. This is going to be a longer video than normal, so I'm going to move quickly. Before we start, just keep in mind that the examples we're going to look at here, they do not represent any kind of standard process or template. So don't just take this and try to use it, to analyze stocks with. This is just really a generic example, and we're using it just to show you how to look at fundamental information in a structured and organized way. All right, so the first step is something that we have not talked about before. It's using a stock screener. A stock screener is a tool that helps us filter for things that we want, and that's important because there are thousands of stocks out there, and we just don't have time to analyze every single one of them. So a screener will help reduce our universe of choices down to a manageable size. Now, here's an example of a simple screen. We can say that we only want to look at stocks that are based in the United States. We only want large cap stocks, which are typically stocks with market value or market cap above $10 billion. For financial health, we can filter for companies that have debt to equity ratios under 1 and current ratios above 1. And in terms of valuation, we can say we only want stocks with PEs below 20 and PBs below 2. As a side note here, I mentioned before that I am a value-oriented investor. That means I tend to emphasize valuation, and I like stocks that look undervalued. That affects how I analyze stocks, and that's reflected in this example. But there are also other types of stock investing. So, for example, growth investing tends to emphasize revenue and earnings growth. We can talk more about this in another video, but the point here is that there are different styles and approaches that we should be aware of. Back to screening. We can find stock screeners all over the internet. This example is from Yahoo Finance. I'm using it here because the interface is very easy to look at. It's easy to use, and we can see here on the screen that our criteria are highlighted in blue, right? U.S. stocks, large cap, and the different ratios. You can see we can actually add more filters if we wanted to. There's that add filter button towards the bottom of the page. But the more filters we add, the fewer results we'll have. So screening is really a balance between filtering enough but not doing too much. This particular screen produces 3 stocks. We have Corning, HP, and Valero. Normally, I like to see more names. I like to have more names to choose from, but this is going to work fine for now. But just imagine not using a screen, right? We would have a list of 7,000 stocks. Like trying to pick from that is really quite overwhelming. So using a screen is very useful, but remember that screening is only the first step. Some investors will just buy whatever shows up on a screen. And personally, I would not do that because I think that there are lots of things that screens don't catch. Now, from this list, I'm going to pick Corning as the stock to analyze, and I'm doing that because I think it's probably the least well known, and I also think it's kind of interesting. We're going to start with quantitative research. Now, we don't have to start with quant. A lot of times I'll actually start with qualitative stuff and I just go back and forth. But we'll go in order here just to keep things easy to follow. Our quant work is going to be financial statement analysis using ratio analysis. All of the info that we need can be found in financial statements, which are found in the company filings. Now, as a side note, we can also find the data we need on all kinds of financial websites. Some websites will even calculate all the ratios for us, and that can be a very easy shortcut. But when starting out, I think it's a good idea to look up the financial statements and to do the calculations ourselves for a couple of reasons. First, the ratios and the data from different websites can differ. It can be due to different dates, different calculations, or sometimes the information is just wrong. And we can eliminate those variables if we just go directly to the original filings. Second, doing it ourselves is the best way to learn. After we've experienced enough, after we've done this enough, then it's okay to start using the shortcuts, because at that point, we can quickly tell if something looks off, if something looks wrong. But the point is, we need to learn to do it first before we start using the shortcuts. That being said, I am going to use some shortcuts here just to make things quicker and easier. So, for example, this is a shortcut for looking at financial statements, and we can access this on Morningstar.com. If we look up Corning on Morningstar, and then we navigate to the financials page, we get a summary of Corning's last 5 quarterly balance sheets. Now, the column farthest to the right, that's the most recently reported balance sheet, and that's the data we're going to use. First, let's look at financial health with the debt to equity ratio, and that measures leverage. Debt is found under liabilities, and equity is found under equity. I've highlighted these things in red. Debt to equity equals 0.216 for Corning. We'll talk about how to evaluate this later, but first I just want to run through all the ratios real quick. Okay, the next ratio is the current ratio, which evaluates liquidity. Current assets are found under assets, current liabilities are under liabilities. I've highlighted that in green. And this ratio calculates out to 3.002. Next is profitability. We can look at profitability using the income statement. This is a summary of the last 5 years worth of income statements from Morningstar. The last column shows the most recent 12 months, or the trailing 12 months as it's often called, and that's the data we're going to use. So profitability can be measured by profit margin, and that's just net income divided by revenue, highlighted in red. Profit margin is 0.241. Profitability can also be measured by return on equity, which is net income divided by equity. Net income is on the income statement. I've highlighted that in green, but remember that equity is actually found on the balance sheet. ROE for Corning is 0.132. Next, we're going to move on to growth, which we can also view on the income statement. Revenue growth can be measured year over year by comparing the last 2 years. So we're going to compare 2016 to 2015, shown in red for revenue, and the growth there was 1.03 or 3%. Earnings growth can be calculated the same way, just looking at net income, shown in green. And for Corning, earnings growth from 2015 to 2016 was 2.76 or about 176%. Now, here's an example of something that looks off. It seems odd that earnings grew 176%, but revenue only grew 3%, right? So the problem with shortcuts is they usually don't provide any additional information, right? If we look into Corning's annual report, we learn that the spike in earnings was due to a restructuring of a joint venture that Corning was involved with, and it was sort of an unusual one-time event, and it was not due to an improvement in operations, so we should not expect it to continue. So this is just a really good example of why it's important to look at source information. All right, lastly, we're going to look at valuation, and we're going to use relative valuation and price multiples to do that. The first multiple is the price to earnings ratio, which is market price divided by earnings per share. Market price is just the current market quote, which is $28.60 right now. Earnings per share can be found on the income statement below net income. I show this in red. Or we can just calculate it as net income divided by the total number of common stock shares outstanding. Notice there are 2 versions of earnings per share. We have basic and diluted. Basic just means earnings per share based on the number of shares currently publicly traded. Diluted includes shares that are not publicly traded, such as shares tied to employee stock options or convertible securities. We're going to use the diluted EPS, which produces a PE of 13. The next multiple is price to book ratio, which uses book value per share as the denominator. Book value per share is calculated by dividing market cap by the number of shares outstanding. Book value per share is 1693, which means the price to book value is 1.68. Now that we have all this information, we need to evaluate it. When it comes to ratio analysis, it's all about making comparisons. So the first thing I do is organize the information and get it into a spreadsheet that's easy to look at and compare. That's what we have here in the table on the left. On this table, we have all the different ratios in the first column and the values for Corning that we just calculated in the second column. In the third column, we're going to compare Corning to industry averages. So, for example, is Corning's debt to equity ratio better or worse than the industry average? Well, Corning's debt to equity ratio is lower than the industry average, and that makes it better. We can find industry data all over the internet. I'm using Reuters.com here. Now, in the fourth column, we're going to compare Corning's debt to equity to its own 10-year history. Is the trend getting better or worse over time? In Corning's case, leverage is going higher, which is worse. And now we can just kind of do this for all the measures, all the ratios, and go down the table. In addition, I include a simple point system for the comparison. So if something is better, it gets 2 points. If it's worse, it gets 0 points, and if it's neutral, it gets 1 point. In the fifth column, we just add up all of Corning's points, and the total translates into a grade ranging from A to F, just like in school. Right? The grading scale is shown on the right. It's simply based on the total number of points possible. So the maximum number of points possible is 32, and the minimum is 0. So I give the top 10% an A, the bottom 10% AF, and the rest are spread across the middle, with the most getting a C, which is average. Corning scores 14 points, which is C or average. This point system, obviously, it's not perfect and it's not precise. Right? The purpose of having it is just to create an objective system that will grade things consistently based on the factual data. If we don't have a system in place, then we're more likely to be biased and erratic with our grading. So that's why I've included this. The second part of our framework is qualitative research, which is using our judgment to evaluate things that cannot be easily quantified. Some good sources for qualitative information include company reports, conference calls, analyst reports, and regardless of where we look, remember the goal is to just understand the company, its business, its risks and opportunities. Now, you've heard me talk about the SEC EDGAR Tool a lot of times, and this is what it actually looks like when you go to the web page. When you navigate here, just click on the company filings link in the menu, and from there we can look up a company's name. And when we do this for Corning, we're going to get a list of different things, different filings. The most recent 10Q quarterly report is sort of in the middle of the list. We'd have to go further back to find the last 10K annual report. Typically, I use the most recent 10Q for the most up-to-date financials, but I will also look at the most recent 10K because that annual report is going to provide more qualitative information. I said before that it can make sense to actually start with qualitative research, and that's really true when we're looking at a company that we're not familiar with. One of the first things we want to do is understand the company, and reading an annual report is one of the best ways to do that. Here's an example of some qualitative information about Corning we can find in its annual report. Corning has been around for 160 years and it started as a glassmaking company. Today, it operates in 5 primary segments, and the largest and most important one is the display technologies segment. This basically makes glass surfaces for flat panel TVs and monitors. But Corning also makes a lot of other things, including fiber optic materials, as well as specialty surfaces for mobile devices, among other things. Something unique about Corning is its long history in glassmaking. Not only has it been doing it for a really long time, but it also has a long history of investing into research and development with respect to the manufacturing process. The result is that Corning can make stronger, larger, lighter, and thinner glass materials at lower cost than any of its competitors, and that makes Corning a very competitive industry leader. So this type of information gives us a much better idea of what kind of company Corning is, and clearly we would not get any of this just by looking at its financial statements. Next, we can look at some risks and opportunities. Risks include sensitivity to commodity prices. Corning does depend on raw materials because it is a manufacturer, and so it's sensitive to those prices. Corning is also sensitive to the business cycle. During a recession, consumers will stop buying 60-inch TVs before they stop buying things like toothpaste, right? So Corning is actually a very cyclical stock, and that's made worse by the fact that Corning's business is also capital intensive. It takes a lot of equipment and a lot of money to make giant sheets of glass. So in a downturn, Corning gets hit by both slowing sales and high costs. Opportunities, on the other hand, include a positive long-term outlook. The demand for larger, thinner, lighter flat panel displays is probably going to keep going up. It has been increasing over time and it's likely to continue, and that's good for Corning's core business. The same thing can be said for mobile devices like phones and tablets. Currently, this is a smaller segment for Corning, but it's actually one of the fastest growing, and so it has a lot of long-term potential for Corning. Okay, the last qualitative area we're going to look at is management and corporate governance. Corning has an experienced and tenured management team led by Wendell Weeks, who's been with Corning for over 2 decades. Management seems to be stable and consistent, and we can kind of see that in its operating results, right? Management has delivered growth in revenue, earnings, cash flow, and book value throughout different economic conditions for many, many years. And at the same time, Corning also spends about 3 times as much in R&D as its competitors, and that's one of the reasons why it's become a leader and is able to maintain its leadership position. Management also seems really interested in representing shareholders. In fact, in 2015, it laid out a very specific capital allocation plan describing how it was going to increase shareholder value through reinvestment, dividends, and stock repurchases. So far, it's not only on track with that plan, but it's actually ahead of schedule. And the market obviously has liked that. Corning was trading around $18 in 2015, and now it's up over $28. Okay, to summarize all of the qualitative information, we use another simple point and grade system. But first, we have to use our judgment to decide if each quality has good or bad implications for Corning. So, for example, competitive position. Corning is clearly an industry leader, and I think that it will be able to keep that position because it has a strong management team and it reinvests in itself heavily. So I think the outlook is actually quite good for Corning. So I'm going to give it 2 points for that. If a neutral rating gets 1 point and then a bad rating gets no points, 0 points. So we can just go down this list and kind of do the same thing we did before, just add up the points. The grading scale is done the same way. It's out of 8 possible points. Corning scores a 7, which is a B or above average. The last part in our framework is to develop an opinion on the stock. And to do that, we need to determine what we think is fair value for the stock. And we can do that with relative valuation and price multiples. The table here is an example for doing that, and we're going to go over it from left to right. So let's start by looking at the price to earnings multiple in the table. We know that for Corning, the current PE is 13. We just calculated that. In the next column, we see that Corning's 10-year average PE is 12, which we got from Morningstar. The next column shows the current average PE for the industry is 16.5. In the next column, we need to come up with what we think is a fair PE for Corning, a fair PE multiple. Now, this is subjective. We have to decide what we think is fair and reasonable for Corning. Now, if we think everyone loves Corning, then maybe we use a high PE, like 20. If we think everybody hates Corning, then maybe we use a lower one, like 8. There's not really a right or wrong because this is based on subjective opinion. I personally don't have a strong opinion either way, so I'm just going to pick a midpoint between Corning's long-term average and the industry average, which is about 14 here. Now, in the second to last column, we have the multiple denominator, which for PE is just earnings per share. Okay, so if Corning's earnings per share is $2.20, and we think people are willing to pay 14 times those earnings, then our fair value estimate is 14 times 220 or $30.80. That's in the last column. We can do the same thing with price to book value, but we're just going to use book value per share as the denominator. And that results in a fair value of $33.86. The average of those two values is $32.33. And we can use that as our estimate of fair value. Now, this was a very simple example. Normally, we would include different types of multiples and also use approaches that are not relative value based, right? So one very common example would be using a discounted cash flow analysis. And that's a different approach, and we'll talk about that in another video. But for now, if our estimate is $32.33, and the current price is $28.60, that implies the stock is undervalued with an expected return of about 13%. In addition to fair value, we could also estimate a target price for the future. That would just create another expected return. We're not going to do that now. The important takeaway is simply that we need to have some kind of price assumption in order to calculate that expected return. Okay, so is 13% good or bad? The answer depends on a couple of things. First, what's the time frame for the expected return? 13% in 6 months is a lot better than 13% in 6 years. Second, what are the other choices from a risk-adjusted perspective? In other words, how does 13% compare to the expected return on something else that is similarly risky? For this example, we're going to use a 12-month time horizon, and that's pretty common for stock analysts. As a comparable investment or asset, we're just going to use the S&P 500 index, which represents the 500 largest stocks in the U.S. So think of that as just the average U.S. stock. The average annual return for the S&P is something like 9 or 10% a year. So if we can expect that from the broad market, then we should want more than that when we invest in a single stock, because that's going to be riskier. So based on my own personal opinions, I created another grading scale using the S&P 500 as a reference. If the market average is 9 or 10% a year, then I think that the range between 7 to 13% looks about average. Likewise, above 13% a year looks good, and above 25% looks very good. On the flip side, anything below 7% to me looks bad or very bad. So based on that, Corning's expected return of 13% translates to, average or a C grade. Okay, fine. We're going to bring everything together and form an opinion. So we have a quantitative grade of C, a qualitative grade of B, and an expected return grade of C. So overall, taken together, I would have to rate Corning as pretty average. I would not consider it a compelling buy unless I really couldn't find anything else that was better. If this was the only thing that I could find that was half decent, then maybe I would say it's a good buy. But based on this alone, no. Analysts would usually label this a neutral, market weight, or hold, which are all basically the same things. And sure enough, if you look at average analyst ratings for Corning, 11 out of 16 analysts who cover Corning rate the stock as a hold. Okay, so in summary, we covered a lot in this series. We looked, at the basics to start with, like what is a stock, and we just ended with a real-world example, a fundamental analysis on Corning. Remember, there are lots of different ways to perform stock analysis. It's not that one way is better than another. Ultimately, what's best really depends on the situation and the circumstances. We used a lot of examples. Remember that they were all simple, generic examples used for informational purposes only. They were not templates that you can just go and use, and it's certainly not advice by any means. Regardless of what tools or approach we do use, it's just important to have a clear and disciplined process because that's going to help us organize information and stay consistent with our analysis. And of course, another important thing to remember is that no matter how fancy an approach looks, we should always remember that markets are just unpredictable, and so we could always be wrong. Okay, so that concludes this video and the series. I hope you enjoyed it. Please like and share if you did. If you have questions or you need help with your own investments, feel free to contact us through this page, or you can also find us on Facebook, Twitter, and LinkedIn. All the links are in the description below. We try to share some useful information every month, so if you subscribe to our pages, we'll keep you up to date on new content. Thanks for watching, and please stay tuned for additional information about this video.